Welcome to episode 3 of our discussion series titled Riding Out the Economic Downturn with Mutual Funds. We're going to be discussing the impact of COVID-19 on equity markets today, and of course the shape of the recovery. What letter of the alphabet are we going to be looking at in the future? I am Monika Halan, consulting editor with Mint, and I have two eminent panelists with me. I have Mr. Saurabh Mukherjea, founder at Marcellus Investment Managers, and Mr. A.Balasubramanian, CEO, Aditya Birla Sun Life Mutual Fund. Welcome to both Saurabh and Bala. I'm looking forward to this conversation. It's always good to talk to other market junkies. And I'm going to kick this off by starting off with you, Bala, and saying that we are seeing data which is being seen as the worst decade of equities. And the equity naysayers are saying that we were right, FDs are better, and the point-to-point 10-year returns are just showing equity in a very poor light. How would you want to respond to that?
I think from the market point of view, interestingly, we were just looking at some numbers in equity. And equity has never been a linear curve that we have ever witnessed, unlike in fixed income, where we may go through some ups and downs. At the same time, eventually, if you draw a curve, it will become a linear curve. And because of various things that we discussed in one of the discussion platform earlier. But equity, of course, goes through a bumpy ride, and ultimately, equity market is driven by both the macro development as well as the earnings of the company. That's where I think the market always evolves. And this year, of the last 4 or 5 years, returns have been taken away. Again, it is again coming back, especially in the last 2-3 months. And purely on the basis of, one, the market estimates there's a complete collapse of earnings thanks to the COVID. So there's completely unknown. When the unknown comes and hits you, definitely the market starts getting worried about how the earnings are going to come, how the companies are going to survive, and how the economic growth is going to come back, and so on and so forth. So that's something I think it's actually taken away all the gain that would have come in the last, say, some number of years and a matter of a few days. Again, if I look at the way I think the policymakers came and reacted so sharply in a very short span of time, pumping in liquidity and try and see whatever the best they can do in order to bring down the interest rates so that the cost of capital for the companies that operate in the equity space gets reduced quite significantly. And that also helps the economic recovery to come back with respect to the interest rates being low and consumption comes back. I think we see these kind of cycles. So the equity is something, we'll go through these kind of cycles, and these cycles at times get preempted by 1 or 2 years of earnings coming back, as well as the economic growth comes back. It always acts in advance to the recovery of the economic growth as well as the earnings growth. So that's something which I think is what we see even today also. Despite all the negative being talked about, the equity markets have done well in the last 3 months, especially. It's purely the optimism is returning, and that's where the equity market functions. Therefore, one has to keep in mind, it's not just only about the earnings, it's all about optimism that surrounding around the equity market. It's also is the driver of the market.
Okay, great. So actually, Bala, I'll come back to you and push back on some of these things that you've just said. But Saurabh, how do you interpret this data? Because you have also the tough job of convincing investors about long term and equity works, and all of us believe in equity. You know, there are 3 people on the panel who believe in equity. But when you have shown that data, how do you respond to that data?
Sure. I think in a way, I call this the paradox of Indian equities. We've had a decade, last decade, nominal GDP growth in India has been around 10%. You see, Monika, Nifty EPS growth has been barely 3-4%, right? And I think that points to the core problem. The challenge, I think, in our country is the Nifty no longer represents the vibrancy of the Indian economy, right? The Nifty is overweighting companies and sectors who simply seem unable to generate a rupee of free cash flow over extended periods of time. And conversely, it makes the job of sensible asset allocators actually easier, because the Nifty is overweighting low quality companies. If you create a portfolio which focuses on cleaner, well-run, highly cash generative companies, you're able to beat the Nifty comfortably year after year. And that therefore makes the job of persuading investors easier. There's another aspect to, I think, the disconnect between the Nifty and GDP growth, which is the rise of venture capital and PE in our country. right? As we've all seen, good IPOs have become increasingly, rare, and the bulk of equity capital in our country no longer comes from the stock market; it comes from VC and PE. So I think we do face some challenges both in index construction and in the ability of the stock market to attract the fastest growing companies in our country.
And I will come back to you to ask you a couple of questions on that. But Bala, back to you. You were saying that rising markets, both in India and the US, US has been on a stampede of a bull run, completely disconnected with Main Street. Is it just cheap money or is it optimism? I would actually think it's just cheap money held by owners of capital looking for deployment.
Yeah, interesting, Monika. I think one of the analysis that you are doing, unlike 2008 crisis, the policymakers were not fully prepared as to how one has to react to the emerging trend, both on the economy as well as the financial world. So it took almost about 1 to 1.5 years for them to come with various measures, and the measures continued to keep the interest rate cheap and work on the faster economic recovery growth. Whereas this time around, if you see, I think in post the March 23rd, is not, we didn't even have a G7 countries meet, G4 countries meet. They quickly actually pumped in liquidity quite sharply. And a matter of about 10 to 15 days, they made the liquidity in the system so large, which now runs in about trillions of dollars. And now it's gone up to almost 10% of the GDP or 13% of the GDP is being given as a support, both in form of fiscal as well as the monetary measures. This is something unprecedented. And when such a large liquidity comes back, it's also obvious to assume that this such a low liquidity has to find its way, and the real rate of interest becomes a challenge because nobody wants to take money in the form of deposits by offering a higher rate of interest. So you drop the rates, and therefore that asset becomes unattractive. So one of the reasons, as you rightly put it, the money, of course, moving towards equity, which is liquidity not able to find its means to a larger theme point of view to find assets which can give them a better return than equity, and therefore the money is, of course, moving to equity. Of course, optimism, when I mentioned about when such a low interest rates are there, somewhere down the line, the consumption has to come back. When the money is remaining cheap and we know that money is not getting deployed at an attractive avenue for them to make return, then they have to, of course, either start spending or they have to start investing in other asset classes which can give them better return. So that's where I think the whole, at this point of time, we take Dow Jones or NASDAQ or even India for the matter, though India reacted a little late, I think we were actually following the global market. We are still to catch up in respect to what we have seen in US and in Dow Jones. And that's the way I think the market is behaving. So the optimism when I mentioned about, there absolutely no doubt liquidity is so large that finding its way. But optimism is coming purely on the basis of the way I think the consumer demand could come back. There is pent-up demand which we saw in some markets where the sudden pent-up demand came the moment lockdown was getting lifted. So nobody has got an answer to that, how that will shape up, in fact. Right. So that's why I think the optimism, some bit of it is coming back.
Right. So Saurabh, so many conflicting trends right now. So yes, there's optimism, there is suppressed demand, but there's also salary cuts and job losses. So on the net, is there really that pent-up demand? Who's going to consume? And are we back to that wonderful phrase that everyone's dancing till the music plays? And some of the worries are that this easy money, 2008 tried to solve it with that, and the world has again done much more. I mean, the debt overhang is huge. So, the worry constantly is there going to be this giant big blowout? Or are we all dancing till that music continues to play and equity keeps going up and earnings at some point will catch up? I mean, in India, we've been waiting for earnings to catch up for, I think, 4 or 5 years now?
And I think, again, the reason that the earnings catch up might not be happening anytime in the foreseeable future is the composition of the Nifty. The Nifty is basically overweighting the old economy. And as we can see...
And why is that? So why is that? Why is the Nifty? I thought there was a formula and then there was a wonderful way of new companies coming in. I mean, every time I've spoken of index investing, I've given that. And now you're saying that doesn't work.
So I think it's a super question. I think it merits probably another proper session from chaired by Monika Halan with the finest index constructors. There is clearly a disconnect. If you look at the composition of Indian GDP from the government accounts and the composition of the Nifty, there is no similarity left anymore. The Nifty overweights sectors like financial services significantly relative to GDP. It underweights sectors like auto and light industrial manufacturing. It underweights technology, right? And a big part of that is these sorts of companies, say light industrial manufacturers, tech companies, are no longer reliant on the stock market's funding. So they're driving economic growth, but unfortunately they're not driving earnings growth. The stock market is left with these old style, industrials, metals, mining, real estate, public sector banks, public sector utilities, which obviously haven't got any ability to drive earnings growth to double digits.
Why? I thought Nifty had a formula. It would trigger and then.
So the Nifty formula basically can only select from what's listed. If I'm a, let's take an example.
So it's a listed versus
that's
the growth really happening under the radar.
Absolutely. So and if you want to go to the real roots of it, just look at how few listings we've had in the last 10 years. We've had a decent economic run in the last 10 years. We've had ups and downs, but overall decent economic run. As Bala and you eloquently described, there's been an abundance of liquidity in the global financial system. Yet our IPO market has been pretty much dead as a dodo through the decade. If you stop bringing in exciting new companies, where on earth will you get earnings growth from? It can't just magically, fructify out of thin air, right? So the stock market is losing dynamism. The private equity and venture capitalists are buying the most dynamic companies in the country. We need to urgently revisit what can be done to bring in young, promising, high-growth companies into the stock market. Without that, even if the economy recovers, which I think it will over the next 2 to 3 years, even if the economy recovers, I don't see Nifty earnings growth going into double digits, right? But that doesn't mean that you and I have to sit here being washed around by the tide of global liquidity. What our country gives us the latitude, the luxury of doing is, India is unique amongst the world's top 10 economies. We're the only country where around 20-25 monopolists sell the essentials of life to all of us. They do so behind immense barriers to entry. And as a result, the average return on capital of a top 25 Indian monopolist is a staggering 45%. There is no other country in the world remotely comparable to us. Not China, not USA, not Germany, not Japan. In any other country, if a market-leading company generated 15-16% return on capital for 5 years in a row, his cover would be on the equivalent of mint in that country. In our country, for 15-16% return on capital, the monopolist won't even step out of his house. He'll send his driver. At 30% return on capital, the Indian monopolist believes the company has arrived. And at 45%, they get industry dominance. Now, what's happening is, in the last 10 years, and we've quantified this, these 20-25 monopolists, their businesses are growing at 20-25% per annum. Right? Consistent earnings growth by the monopolist franchises of 20-25%. They're generating massive free cash flow. They're reinvesting it in new plants, new products, and growing the business. Right? So HDFC Bank, Nestle, TCS are examples of these cash monsters. Right? They've got immense resources. They're reinvesting and growing at 20%. And a classy Indian portfolio is anchored around these stocks. Right? The challenge is the rest of the country, over the last decade, the rest of the listed market has grown earnings at 1% per annum. Right? So the dichotomy is intensely sharp. 20-25 companies growing at 20% odd per annum. Rest of the listed market, I'm afraid, 1% earnings growth. And the challenge with large fund houses is the large fund houses obviously have the bulk of their portfolio in the lower growing companies, and which makes it very difficult for their funds to generate returns. And I don't think this problem can be wished away. We need to revisit what we can do to attract high growth companies into the market.
Very interesting. And this is actually, you said, a completely separate conversation, but I want to move to the second part of this discussion. And this is something that actually I struggle with, because our definition of long term seems to change with markets. So when you're in a bull run, some of us hear that long term is between 5 to 6 years. And when you look at rolling return data today, I've just looked at that rolling return data, we are not seeing a positive minimum return before 11, 12 years. So Bala, I want to ask you, when we are talking to investors and they are saying, okay, what is long term? How do you answer that question? Because according to me, it depends where you are in time.
Interestingly, Monika, this question, every time we try to address it, and during the budget time, because budget, if you look at long-term capital gain tax, is for more than 1 year and then 3 years and so on and so forth. And this question, whenever we address that, it comes. I think when it comes to the question of equity, I think most of the time we always believe that it has to be thought about as if I'm making for the perpetuity. The sense that I'm investing in a business or company which is an ongoing business and is going to be there not just for one generation, it's for the multiple generation. As Saurabh mentioned about all these entry barriers, return on capital is going to be very large, and the product positioning is pretty good. And that's why I think where we have to choose the portfolio, then it's a question of making the investment for long term. Even from investors' point of view also, and nobody comes for actually 2 years, 3 years, or 5 years, knowing very well the money is actually is for perpetuity, except that he's trying to actually time the market and therefore trying to actually encash his profit or book his loss and so on and so forth. Therefore, the way I look at it, equity has to be for perpetuity unless until he needs his money. And when it comes for the purpose of questioning, for the question of last 10 years returns not been very, very good. And the fact of the matter is, of course, as the economy is growing and the market, of course, breadth is rising. As the pool of money, where the pool of money is also, of course, rising, which is actually the case in the equity market most of the time, the pool of money will keep rising. And naturally, some of these companies which has got a very high growth would become a smaller in size compared to the money that are available for it to invest. So that's something I think will always be a challenge. Therefore, the portfolio will always end up having companies with high return on capital employed, running in say 40, 45. There will be a year where you will not get return. There will be a year where you will get return. That becomes a part of your core portfolio. At the same time, in order to take advantage of the emerging trend, which probably may not be long lasting in nature, but naturally, of course, there is a merit for certain companies to be looked at purely on the basis of the valuations and value or dividend yield kind of model. Then, of course, you own them in the portfolios, and that comes as a part of a satellite portfolio. That's where money manager does it. At times, this strategy can lead to relative better performance and underperformance. But as long as once complete the full cycles and then stay invested for long term, at the same time, money manager's point of view, keep revisiting the portfolio construct on an ongoing basis, keep doing a course correction because nothing is permanent in this world except on few things, and therefore you need to keep doing the course correction. And that could ensure the overall experience with investors in the long term is good. But still, it will not answer the question of long term is 3 or 5 years. And given the fact that equity has to be looked at as for the perpetuity, the moment they have that mindset, then it completely takes away the question itself, what should be the time frame for which I should come.
Right, but Bala, so assume that we can convince someone that it's perpetuity and all that, but at some point when they need the money, and if that point is 7 years in a down market, after 7 years, if he's not getting his capital back, then it's a dream that you're selling, which is not really true. So, which is why it becomes important to say there must be a certain time period of holding after which your return on capital will be at least that much. So, how should investors, how do you deal with this problem of, but my money has not grown?
No, I think this, I would assume, Monika, that I think finding an answer to this will remain a search for an answer, but we don't get an answer. The very fact that I told you on post-2008 crisis, and most of us in the financial market felt the world has come to an end after the collapse of Lehman Brothers crisis. And most of the financial institutions, especially being the financial market, everyone felt that I think the complete economic growth will go for a toss and the companies will actually shut down and so on and so forth. And when I look back, such a huge crash we have seen, exactly what we are seeing today, maybe not today, maybe about 3 months back, I would have had a similar experience. I think as the growth comes back, it's of course at times one may get caught in this in a cycle in which probably will not have made return. It's like people who actually put money between 2007 as the peak of the market, then naturally would need not make money for 2008, 9, 10, 11, 12, 13, but he started making money only from 2014. But somebody would, of course, made an investment in specific stocks, but that's, I think, has to be considered as an exception. But I think the broader portfolio construct would not have made money. But ultimately, one good cycle takes away the loss and get into profit. The reason why I'm specifically saying, the last 10 years, I looked at each year how the markets have performed. There was a year market gave a 30% negative return. There was a year subsequently gave a plus 3% positive return. There was a year market gave on a single stretch on a January to December period, 56 and 78% return. The subsequent period is negative return. So that's where the overall markets have behaved. And even companies also, even good companies with a high ROC kind of companies, they perform say 3 years, very good return it gives, and 1.5 years go through a PE corrections, and then earnings catch-ups, and then goes into cycles. So that is one of the reasons I'm mentioning that while the answer will still remain unanswered, whether it's 5 or 7 years, but the fact of the matter is the real compounding happens on a continuous earnings coming back, and that reinvestment generates higher return on investment, and therefore it generates return in the long term. That's something will remain as a theme when it comes to the question of investing in equity.
Saurabh, you want to respond to that? How long is long term? And should investors look at equity investing as perpetuity? And then it comes to the question of when I need my money back, what time period is that?
Yeah. So I think look, I agree with Bala that the investor out there should take I would say at least 3-year view when they invest in equities. But I think by focusing on the investor out there, we somehow miss the point, right? The investor out there will do what he needs. I think we need to focus on our own industry. So I used to be a broker for a long time before I became a fund manager. And I know the mutual fund industry like the back of my hand, like debt, equity, most fund managers I know. Forget the investor there, the mutual fund managers struggle to think beyond 3 months, right? Forget the equity fund manager, the debt fund managers struggle to think beyond 3 months. So I think before we as fund managers tell the public take a long-term view, we could look at our industry and say, do we take a long-term view? Right? Look at a typical large cap mutual fund, or look at the Nifty. It's replete with companies with accounting issues, broken balance sheets, poor governance, zero succession planning, zero regard for the environment. Where do we see stewardship on the fund manager's part? So I don't think we can, in forums like this, or indeed in respectable publications like yours, I don't think we can be turning the owners back on the investors to say, you take a long-term view. I think the industry itself has to show that we can take a long-term view. I don't think Indian equity fund managers or Indian debt fund managers have shown that they're intellectually capable of taking more than a 3-month view. So it becomes a little bit of a facile debate. The public looks at us and says, you guys keep focusing on quarterly earnings. I'm going off to buy gold, right? Which is a crushing disappointment for us.
Gold, that's right.
And in a way, if you lift the debate up one more level back to the exchanges and the regulator, the challenge facing the exchanges and the regulator is how do we attract the next generation of fast-growing companies who are being given checks by American venture capitalists, American PE, who are taking a 10-year view when the stock market is focusing on next quarter's earnings, right? So this myopia that our fund managers and our stock market and our bond market is demonstrating needs to be addressed at the highest levels. If we don't do that, the investors are going to abandon us, and the investees, the most exciting companies in India, are going to abandon us.
So I'm going to take it off from there and say that where does the investor go then? Because investors tend to think in terms of a or. It's a gold or, it's a debt or equity. They never think of the gold and equity, debt and equity, and then this whole thing of real estate investing. And the prices of real estate are terribly disjointed from reality of what really it should cost. So Bala, how should an investor think about asset allocation? I mean, it is such a difficult thing to actually explain. And if Saurabh is saying that investors are going to abandon equity, where do they go?
That's why I earlier mentioned about what Saurabh made is perfect. At the end of the day, we all keep looking at quarterly numbers and the earnings guidance that's being given by the companies, which of course make the stock price move. And therefore, the money managers at times tend to trade in, trade out to take advantage of the price movements that comes in, as long as it's able to generate alpha in the portfolio. But having said that, from money managers' point of view, we have some of the funds in our own various schemes that we are offering. would have a least turnover because the fund itself is supposed to invest in only on those companies which are high growth companies run with good corporate governance and good promoters like MNC and consumption driven kind of themes. This of course remains a permanent theme where you buy companies and sit on it tight and go through ups and down cycles but stay invested. That's why I think you create a permanent portfolio. From investors' point of view, I think ultimately timing of such things is not going to be very easy. I think what would remain constant for the investors actually is about asset allocations. When I mean asset allocations, of course, today, if you look at exactly the reverse of equity, what you're just saying, the way I think interest rates have come down, you look at from any parameter in any period, so between say March end last year to the previous period, and now to the previous period, in the fixed income space, given in a double-digit return. Whether the double-digit return is going to be permanent, absolutely no. I think we'll go through again in cycles when the interest rate starts rising in say down the line 2-3 years. One can't roll out there as well. So again, we'll go through some ups and downs. So in these kind of scenarios, whether anyone will be able to predict which asset class will perform substantially better than each other, I'd say very difficult. At the same time, as Saurabh mentioned, money managers ourselves at times will go through this uncertainty of dealing with the VUCA world, which of course affects the market sentiment. Therefore, we as public money managers need to, of course, pay attention to that. But having said that, within the asset allocations, whether it is gold, whether it is an equity or in the fixed income, which is a common theme, which somehow I've been a believer that when an equity does well, if you go overboard an equity, people on the base of past return, there is a high probability of seeing a failure. And the same way in the fixed income space, looking at the past high return, if I say in a fixed income asset class, I need to go, there is a high probability of facing the disappointment. So keeping this in mind, if I keep, which is the normal principle, I always say that 50-50, you start with between equity and debt, and then keep moving up and down, depending upon where you want to go between these two asset class. And gold as an asset class, again, one has to look at from a tax-adjusted basis point of view. If I'm able to find an alternate within the fixed income space, which can equally give a better dollar-adjusted return on my investment, then the question is that I need to go for a gold. But otherwise, all the three asset classes makes a lot of sense. Recently, one of the trend change that I saw in the global market, of course, more of temporary, I would assume. The reason why the gold and equity in both asset classes are doing exceedingly well in the global market, because interest rates have been pushed down to such a low level, there is absolutely no return that can be made out of such investment. At the same time, the risk that I am carrying on holding such investment, I think is so high. I'd rather take a risk in some other instrument, which is a real risky assets, which is an equity. And the gold, of course, can come as a hedge for both the dollar and other things. This way, I think the global asset allocations are moving. So I would assume is a broader principle on which if one actually applies their mind towards investments between these four asset classes, I think that can give, and then he can move away from what the money manager is thinking and how he is going to manage his portfolio and what is his view. I think we can move away from that, make it completely agnostic of market, agnostic of money manager's views, and stick to the discipline of allocations.
Right. Saurabh, very quickly, it's not a question which can be answered quickly, but do try and give me a couple of minutes on this. How do you deal with real estate? I've seen some very interesting data that your company has thrown out on percentage of per capita income to GDP, what real estate costs, and India's graph is off the charts. It is just hugely expensive. That's one. And second, you had shared earlier that you are seeing real change in behavior in tier 2, tier 3 towns of investors actually understanding real estate is a no deal and moving to equity. Do you want to quickly comment on this?
So I think, as they say, right, necessity is not just the mother of invention. In our firm, we say necessity is the mother of asset allocation as well. So what we are seeing is a whole generation of executives and SME owners approaching retirement over the next 10 years. And as they do so, they realize that 80, 90, 95% of their wealth, if you look at the RBI household finance survey, RBI is saying 95% of Indian wealth is in gold and real estate. Now, I'm afraid with gold and real estate, nobody can finance a retirement, nowhere in the world, and certainly not in India. So what we are seeing is with the kind of executive class, the white collar executive class in cities like Pune, Bangalore, Hyderabad, and with the SME owners, especially in second tier, third tier towns, this move to build out, to reduce the dependence on physical assets and increase their allocation to financial assets. I think that is the main driver of growth for the mutual fund industry, for the alternatives industry in which Marcellus participates. And I think this trend will continue. Ironically, all that the SME owner wants to know is, put me in a broadly sensible portfolio. He's not even saying I want 20% returns. From what I can see, he's not even benchmarking anybody to the Nifty. He's just saying, put me in a broadly sensible portfolio, which can give me 9-10% per annum. So that need to fund a retirement, right, over the next 10-15 years is the biggest impetus that our industry has. I suspect had it not been for that, we might not be having this lovely dialogue.
Right. No, it's very, very interesting. I mean, when you see broad changes happen across behavior and investing, it's fascinating. We are in the last 5 minutes, and I want to ask you your letter preference. Which letter of the alphabet do you think recovery is going to be? We have all options from A to Z right now, U, V, W, I. Bala, what do you think and why?
Yeah, I think interesting. I think before when the lockdown started, and all of us felt that I think things are going to be very bad, and because we're not sure how the policymakers will react to this kind of pandemic situation. I think the way the pandemic situation people have reacted, the way the rates are brought down, it actually makes us believe that one can expect a V-shaped recovery as we move forward. Of course, not in the next 6 months time frame. I think this whole of 2020 seems to be more or less a year of lesser expectation that one need to keep. I think 2021 there's high probability of V-shaped recovery coming back, purely because of, again, I come back to the earlier point, high liquidity, low interest rates, and is going to long last for too long, and therefore that can ultimately force the consumers to come back to sort of spending. Therefore, we could see that V-shaped recovery coming back. Again, one has to also keep in mind V-shaped recovery. Also, one has to keep in mind from where they are today, which have almost gone to the negative. Any growth that comes in may even any case look like V-shaped recovery. Also keep that in mind.
Right. Saurabh?
I think another way to think about this, if you look at our country in the last 40 years, we've had only 4 periods of accelerating economic growth, right? 82 to 86, 93 to 97, 2003 to 2008, and 2009 to 11, right? Before every single period of accelerating growth in India came a US recession. So in other words, we've never had an economic boom in India without a US recession preceding it. And there's never been an economic recession, there's never been a US recession in the last 40 years without a boom in India following it. I think we're going to follow that template this time. There's 2 reasons why a US recession leads to a boom in our country. America going into recession smashes the price of oil by 50 to 80%. It's happened again this time as well. That gives us around a 3% of GDP boost because we're an oil importing country. And the second thing, as Bala himself has just said, America going into recession brings down the US 10-year bond yield by 200 to 300 bips. That gives the RBI room to cut by as much. Cheap oil and cheap money. Those are the only 2 things that have driven Indian recoveries. We've got that, we'll recover.
And what sort of time frame do you see? I think
it's already begun. No? If you see the auto data, it's just mind-blowing. Like through June, July, Hyundai, Maruti pretty much back to normal. Hero MotoCorp, Bajaj Auto, 70-80% are normal. Consumer durable sales are roaring. So given that we haven't even unlocked the economy fully, you can see it in, say, RBI credit offtake data, which for a quarter ending June was 7-8%, which was unbelievable. HDFC Bank credit growth at 21%. I've spoken to several bankers. They're saying credit disbursements at the moment are comparable to January, which again is quite remarkable given what we have lived through. So cost of money, I suspect, falls by another 100 bips in India over the next 6 months, to bring us in line with the drop in US bond yields. And if oil stays at $40, I reckon the government can do another 0.5% stimulus. So the stimuli continue, whether it's in India, whether it's in Europe or America. Money stays cheap. We also have an imminent threat in the northern borders of the country, which is bound to lead to import substitution. Between APIs, electronics, defense, that's another 2-3% of GDP that will come from import substitution. So this is as clear an economic recovery outlook as I think we'll ever get in our careers.
So we are both panelists are looking at a V-shaped recovery. And if this were, it's probably very, very good news for equity investors that growth seems, you predict that growth will come back and growth should reflect somewhere in the markets, despite what Saurabh has reservations about. But finally, we should see some earnings growth come back on the listed stocks. With this, I think it's a wrap. I want to thank the panelists, both Saurabh and Bala. I have really enjoyed this conversation. It's always good to talk to other people who understand markets and are able to join very disconnected data and give a whole story out for investors, for viewers. I hope this discussion helps viewers to take better decisions.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.